Right now, somewhere in the world, a gold trader is staring at a screen that stopped moving. And the terrifying part is, he has no idea if it's going to start again. That scenario, the frozen screen, the locked out account, the dealer saying, "We can't fill that order right now," is exactly what thousands of people are quietly panicking about tonight. And before you brush it off as exaggerated internet noise, I need you to understand that parts of it are real. Not all of it, not the version being screamed in headlines, but enough of it that if you hold gold, silver, or any position in precious metals right now, you need to actually understand what's happening and what it means for you specifically. Tonight, we are going to break this down completely. No drama, no theater. Just the clearest possible picture of what a metals freeze actually is, what's driving the fear right now, and what you should actually be watching. Because the difference between the people who come out of volatile nights like this in good shape and the people who don't almost always comes down to one thing: clarity before the chaos, not during it. This is exactly the kind of breakdown we do at Element Axis, and if you're not already subscribed, hit that button right now. Because on a night like this, having a source you can count on for calm, clear analysis matters more than it does on any ordinary day. Subscribe, stay close, and let's get into this. Here is the single most important thing I can tell you before we go any further. When people say the metals market could freeze tonight, they are not talking about one event. They're actually talking about three completely different things, and they are blending all three together into one terrifying sounding claim. That blending is exactly where the confusion comes from. That's where the fear multiplies faster than the facts support. So the first thing we're going to do is separate those three things out, because the moment you see them individually and clearly, the whole picture shifts from apocalyptic to manageable. The first thing someone might mean when they talk about a metals freeze is that one of the major organized trading exchanges hits what's called a price limit, a circuit breaker, a threshold built directly into the exchange's rulebook that says, if price moves this far, this fast, we are going to pause things. Now this is a real thing. It genuinely happens. But it is not a glitch, and it is not a conspiracy. It is a feature. It was designed deliberately by the people who built these markets. When price moves too violently in too short a time frame, the exchange creates a forced pause, a moment for everyone to stop and reassess. And if you see that happen tonight, it does not mean the market is broken. It means the market's safety architecture is working exactly the way it was designed to work. The second thing someone might mean when they talk about a freeze is a much more narrow and localized event. A retail platform, meaning an online broker, a trading app, a dealer's website, temporarily stops processing orders. Maybe the traffic volume exceeded what the system could handle. Maybe the risk management team inside that company decided they couldn't responsibly be on the other side of every order coming through at that moment. Whatever the cause, this kind of pause is specific to that platform. It does not automatically mean every other venue on Earth has also stopped. It means one door temporarily closed while other doors are still very much open. The third thing people might mean when they use the word freeze is the one that is most misunderstood and the most practically relevant for people who hold physical precious metals. This is when the price you see on your screen no longer matches what you could actually go out and buy or sell metal for in the real world. The chart is moving, the spot price is updating, but the physical layer, the actual bars and coins sitting in dealer inventories and moving through shipping lanes, has already diverged from that paper price. You'd try to buy silver rounds at the spot price you're seeing and find out that the dealer's premium is significantly higher than it was last week. Or you'd find certain products listed as out of stock. Or the delivery estimate that used to say 3 to 5 days now says 4 to 6 weeks. The chart didn't freeze, but the real-world experience of transacting absolutely did. That is a logistics freeze, a supply chain story. And it plays out slowly, unevenly, one product type at a time, one region at a time. Those three scenarios, an exchange-level halt, a platform-level pause, and a physical supply disruption, feel like the same thing when you read a headline designed to scare you. But they are profoundly different in terms of what caused them, how long they're likely to last, and how serious they actually are. Hold that framework in your head as we walk through the three specific things people keep pointing to tonight. The first ingredient is Dubai. And I want to be straightforward with you. This is not a random talking point. The United Arab Emirates has genuinely developed into one of the largest and most significant gold trading hubs in the world over the past decade. So when people connect Dubai and gold in the context of rising Gulf tensions, there is a real underlying fact worth acknowledging. But here is the distinction that gets lost almost immediately. A hub being stressed or disrupted is not the same thing as the global market shutting down, not even in the same category. Think about how any network actually functions. When pressure hits one node, the network doesn't collapse. It reroutes. If specific shipping routes become too expensive or too risky, the trades don't evaporate. They get repriced and find different routes. If one refinery slows, the metal shifts through different fabricators and corridors. Does disruption in the Gulf create genuine friction? Absolutely. Could it show up as wider spreads, higher premiums, slower delivery windows? Yes, yes, and yes. But none of that is a chart going dark. What you're looking at in that scenario is a physical supply story, and physical supply stories are slow and messy and regional. They do not flip one switch and immediately affect every market on Earth simultaneously. The greater danger is not that gold becomes untradeable. The greater danger is that you see a price on your screen and assume you can transact at that price, when the physical world has already moved somewhere else. That gap between what the chart shows and what you can actually do is what people mean when they talk about paper price versus physical reality. We will come back to that gap because it matters enormously for anyone thinking practically about their metals holdings. The second ingredient is a message or notice suggesting that under conditions of extreme market movement, a specific platform operating in China could close trading or restrict it significantly. Notice what that actually is. It's about one platform, one set of products, one jurisdiction, one set of internal risk rules. It is not a statement about global gold and silver trading. Modern precious metals markets don't run through a single pipe. They run through dozens simultaneously: futures, options, ETFs, swaps, bank products, online retail platforms, physical dealer inventories, vault programs. If one pipe gets pinched, the money doesn't stop existing. It finds the next pipe. The existence of a risk control message from a specific platform is not proof of imminent collapse. It is proof that someone has a risk management team doing their job. Sometimes what looks like a scary closure notice has almost nothing to do with the metal itself. It has to do with the platform's internal liquidity, its ability to handle a situation where too many participants are rushing in the same direction at once. When that happens, a platform can find itself unable to take the other side of every incoming order without exposing itself to unmanageable risk. So it pauses. That is one institution making a self-protective decision. Other venues keep trading. The price keeps printing on other screens. The world does not end. The third ingredient is Thailand, where reports suggest that online gold trading was briefly suspended after volatility spiked following Middle Eastern escalation. It's a genuine real-world example of a local or platform-level pause, but it tells us that one venue, operating in one country, crossed some internal threshold and responded by pausing. It does not tell us that no one on Earth could buy or sell gold at that moment. One specific door got a temporary gate, nothing more. We've seen this dynamic even at much larger scale. A major American metals trading platform once experienced an outage that halted trading for over an hour. There was no geopolitical catastrophe behind it. It was technical, but when it happened, other venues kept operating, prices kept printing, and the market kept finding a way to function. Hit the like button right now if you're finding this useful. It genuinely helps this content reach more people who need exactly this kind of clear breakdown on a night like tonight. And drop a comment telling me what state you're watching from. Now take all three ingredients together. A major physical hub potentially under geopolitical pressure, a risk control message from a platform in China, a reported brief trading suspension in Thailand. Does that add up to global precious metals markets going dark tonight? It does not. What it adds up to is this. Risk is elevated, volatility is likely elevated, and various parts of the metals ecosystem are more likely than usual to hit their individual safety rails. That is serious. That deserves your attention. But it is a fundamentally different story from a master switch somewhere getting flipped and every gold and silver transaction on the planet going dark at once. Now let's talk about what a lot of people are watching tonight, and that's the open. If you've ever been awake on a Sunday night watching metals prices tick after a weekend of intense news flow, you know the feeling. Liquidity is thinner at opens, spreads are wider. A single sharp headline can push price in ways that would require enormous institutional orders to replicate during peak trading hours. A lot of people tonight are expecting a gap up, meaning the first prices that print when trading opens are noticeably higher than where things closed in the prior session. Oil has been one of the clearest real-time signals of how markets are reading the geopolitical situation. When there are credible concerns about major energy shipping routes being disrupted, particularly something like traffic through the Strait of Hormuz, oil does not drift politely upward. It reacts sharply. And when energy prices spike, consequences spread through the entire economic system. Transportation costs rise. Inflation expectations get revised upward, and almost reflexively, demand for assets seen as stores of value, gold and silver prominently among them, tends to increase. That is one of the most reliable dynamics in all of markets during periods of genuine geopolitical stress. Here's something important to layer on top of that. Gold was already in a structurally strong position before any of this started. Central banks have been consistent, steady buyers of gold at historically elevated price levels. And central banks are not day traders. They're not reacting to a headline. When they're adding to gold reserves at these price levels, it's because their long-term reserve strategy calls for it. That is patient money. And when patient money with structural conviction is already present in a market and then a shock hits, the reaction can be sharper and more sustained than simple short-term volatility would suggest. The existing demand accelerates the move. It makes the floor firmer than it might otherwise be. But it also means upside overshoots can be more dramatic because you're adding fear-driven buying on top of demand that was already strong. Now, let's talk about what actually breaks first in moments of extreme market stress, because it is almost never what people assume. Most people imagine a chart stopping, a frozen number, a dead screen. But what breaks far more often and far earlier is liquidity. Liquidity is simply how easily you can buy or sell something at a price close to what you're looking at. When liquidity is healthy, you press buy and get filled at essentially the quoted price almost instantly. When liquidity gets thin, the distance between what buyers are willing to pay and what sellers are willing to accept stretches out. That distance is called the spread. When spreads blow out under stress, trading doesn't stop. It becomes expensive, slow, and unpredictable. What you often see in a stressed market open is not a chart that goes blank. You see a chart that keeps moving, sometimes violently, while the quality of what those prices represent deteriorates. You might see a bid and ask so far apart that nothing is actually trading between them. The screen shows numbers, but the market is effectively illiquid at those quotes. You might try to place an order and find it takes much longer than usual to fill. None of that shows up as a freeze on the chart, but it feels like one in real time. That's the system under high stress. Not broken, just very expensive to operate inside of. And this brings us to leverage, which almost never comes up in these conversations until it's too late to matter. A huge portion of activity in gold and silver markets involves futures, options, and derivatives, positions where a small amount of capital controls a large amount of exposure. In a fast-moving open, leveraged positions feel every tick immediately. Margin requirements can be adjusted in real time with almost no warning. And some traders, not because they decided to sell, but because their account can no longer absorb the position at its current size, get forced out. When forced selling hits the market in a cluster, bids can vanish temporarily. Price can whipsaw in ways that look alarming. But it's really just leverage doing what leverage does when conditions get extreme. If tonight opens with a strong move, don't assume it's a straight line from that point. What typically happens in a highly volatile open is a sequence, not a single move. Price jumps and there's excitement. Then profit takers emerge. Price stalls or pulls back. Then forced sellers arrive, people who didn't choose to sell but whose positions became too large for their available capital. Price whips again. Then new buyers enter on the pullback. That's not breakdown. That's what volatility actually looks like from inside it. Share this video right now with someone who's been watching fear-heavy coverage tonight and feeling overwhelmed. This is the kind of breakdown that actually helps people think, instead of just scaring them. Think of the precious metals market as 3 distinct layers. The first layer is the organized futures markets, high-speed, high-volume venues, where institutional money operates and price discovery happens first. This is also where an official exchange-level halt would occur if triggered. The second layer is retail platforms, broker apps, and online dealers where individual investors participate. This layer follows the first with a slight delay and is most prone to platform-level restrictions when order volume overwhelms systems. The third layer is physical supply itself, the actual bars and coins and inventories, moving through shipping lanes, clearing customs, arriving in people's hands. This layer is the slowest to respond and most constrained by physical reality. These layers do not move in perfect synchrony. In calm markets, the differences are invisible. In stressed markets, they can separate significantly. You can have a futures market moving freely while the physical layer is already tightening. You can have one exchange halt in one venue while other venues across other time zones still print prices. That's why you cannot judge the health of the overall system from one screen alone. Drop a comment below and tell me which of these 3 layers you personally care about most. Your answer tells you exactly where to focus your attention tonight, because each layer has different vulnerabilities and different warning signals. Now let me address something that almost never shows up in these conversations: settlement. Most people have no idea what it is in market context, and most of the time that's fine because it happens invisibly. Settlement is the back office process by which the system confirms that the buyer has the funds to pay and the seller has the collateral to deliver. In normal times, completely invisible. In severely stressed times, if leveraged participants can't cover their obligations because price moved further than their capital can absorb, settlement stress becomes the real issue. When that happens, exchanges can raise margin requirements sharply, change trading conditions mid-session, and in historically extreme cases, cancel trades already made. That kind of intervention is rare and requires very different circumstances than elevated volatility. The practical distinction to hold on to: volatility, even severe volatility, is uncomfortable but manageable. It resolves. Broken settlement is a different category entirely. If tonight unfolds as high volatility with some platform friction and some physical premium increases, that's stress, normal stress. Keep those two things clearly separate in your mind as the night unfolds. Now, let's come back properly to paper versus physical, because this is genuinely where most of the confusion lives. Paper gold and silver, futures contracts, ETFs, and other instruments that give you price exposure without requiring physical possession can trade at enormous volumes because you're swapping claims and exposures. No metal has to move. Physical gold and silver is constrained by reality. There's only so much of it refined and available at any given moment. It has to be transported, insured, cleared through customs, and stored before it reaches your door. In normal conditions, paper and physical track each other closely enough that most participants never notice the difference. In stressed conditions, they can separate significantly. You can be looking at a spot price on your screen and simultaneously discover that dealers are charging premiums well above that price, that certain products are out of stock, and that delivery estimates have stretched from days to weeks. The chart is not frozen. But the real-world price of actually getting physical metal in your possession has already moved somewhere else. That divergence is what people describe when they warn about paper and physical coming apart. And in an environment where a major physical gold hub is under genuine geopolitical pressure, that gap can widen faster than most people expect. Here is a practical checklist of signals to watch tonight. If gold and oil are both rising simultaneously, you're looking at straightforward geopolitical risk repricing. If gold is rising, but oil has stabilized, it's more likely a pure safe haven demand story. If silver is significantly outrunning gold on a percentage basis, that signals speculative energy flooding in, which can produce explosive upward moves but also sharper reversals when positioning gets unwound. If the bid-ask spreads on your platform are notably wider than usual, that's a liquidity warning. If you see official announcements from exchanges about trading pauses, exchange-level safety mechanisms have been triggered. And if you're trying to buy physical metal and running into out-of-stock messages, higher premiums, or extended delivery timelines, the physical supply layer is tightening in a real and tangible way. Each of those signals points to a different cause and calls for a different interpretation. Developing the ability to identify which one you're actually seeing, rather than lumping everything under the single word freeze, is the skill that separates people who make clear-headed decisions in volatile moments from people who react emotionally and regret it. Now, let me address the emotional core of why these freeze narratives get so much traction. The fear underneath all of it is real. What if I need to sell and I can't? What if I need to buy and there's nothing available? Those are not irrational fears. But here's the honest answer. The scenario where access to precious metals goes completely to zero through any venue anywhere in the world is extraordinarily rare and requires circumstances far more extreme than anything being discussed tonight. What is far more realistic is that access becomes more expensive and more inconvenient. You might not get the exact price you saw on the chart. Physical delivery might take longer. Premiums might be higher. That is frustrating. But it is categorically different from being trapped with no exit. The realistic risk tonight is friction. And friction, while annoying, is manageable. Let's talk about silver specifically, because it catches a lot of people off guard. Silver is not simply cheaper gold. On top of whatever monetary and safe haven demand it shares with gold, silver also carries significant industrial demand in manufacturing, electronics, and solar panels, making it sensitive to the broader global economy in ways gold is not. Silver also operates in a smaller market with thinner liquidity. All of those factors combine to make silver significantly more volatile in both directions. When uncertainty spikes and money rushes into metals, silver tends to amplify the upward move dramatically. But when the direction reverses and margin calls start hitting leveraged traders, silver can reverse faster and harder than gold. If silver is leading gold significantly tonight, treat that as a signal of speculative heat entering the market. Track whether it holds that premium or gives it back. That behavior will tell you a great deal about the nature of the move you're watching. I want to be honest with you about something especially relevant for people watching this in their late 40s, 50s, or beyond. The emotional weight of financial uncertainty is not equal across all age groups. When you're 28, you have decades to recover from a bad decision. When you're 52 or approaching retirement, the same volatility lands differently. The stakes feel higher because the runway is shorter. That difference in emotional stakes can make people more vulnerable to reactive decisions that tend to be the most costly. Selling at peak fear, often near a bottom. Buying on a spike because the excitement was too strong to resist, often near a short-term top. The decisions that age well in volatile markets are almost never the reactive ones. If you've been building a position in gold or silver as part of a deliberate long-term strategy, ask yourself tonight, does what's happening actually change my fundamental reasons for holding these positions? If your thesis was about long-term monetary debasement, geopolitical instability, or distrust of fiat currency, does tonight's open change any of those fundamental drivers? If the answer is no, the volatility you're watching is not a signal to abandon a carefully considered strategy. It's just the market doing what markets do when the world gets complicated. Let me bring everything together now in the clearest form possible. A freeze is not a single event with a single meaning. It's a spectrum of friction that exists at different intensities and in different layers simultaneously. At the mild end, spreads widen and execution slows. At the moderate end, platform restrictions affect specific venues, but not all of them. At the more significant end, official exchange-level halts triggered by built-in safety mechanisms create temporary disruptions that are disorienting but are not signs of a broken system. And at the extreme end, the end that requires very different triggers than what's being discussed tonight. Settlement-level stress forces extraordinary emergency interventions. Most of what you are likely to see tonight, if things get intense, will live somewhere in the mild to moderate range of that spectrum. Don't anchor to any single outcome tonight. Markets have a way of doing the obvious move first and then doing the opposite. If everyone is positioned for a strong gap up, you can get the gap, and then a sharp fade as the crowded trade gets unwound. No one can tell you with certainty what tonight will look like. And if anyone is claiming certainty, they're selling you something. What you can do is watch the signals. Watch how oil behaves. Watch whether spreads stay manageable. Watch whether official exchange actions get announced. Watch whether physical premiums start moving. Watch whether silver is leading or following gold. And above all, watch your own reactions. Because your own decision-making is actually the layer most vulnerable to a freeze in a moment like this. Stay grounded. Stay clear. Ask which layer. Ask which venue. Ask what type of friction you're actually seeing. Don't let the most dramatic framing of a story replace your own capacity to think it through. Because that capacity is the most valuable asset you have in any volatile market environment. The people who come through moments like this in the best shape are always the ones who had a clear model, kept their head, and refused to let a spike in volatility turn into a spike in bad decisions. If this kind of analysis is what you want more of, make sure you're subscribed to Element Axis. Share this with someone tonight who's been caught up in the fear cycle and could use something that actually helps them think clearly. Drop your thoughts and questions in the comments below. Tell me where you're watching from. Tell me what you're seeing in your corner of the market. Because the conversation doesn't stop when this video does, and your questions shape exactly what we cover next.